A lost decade in stock markets while gold and silver outperform. Hi everyone and welcome to Ainslie Insights, brought to you by Ainslie Bullion, Ainslie Crypto and the Gold and Silver Standard. Today, welcome back Dhruv, who's been continuing to look at this topic really about how cycles interplay and what we can expect, but really turning his focus this time to the stock market. It's one that has been catching everyone's attention over the last few days. How are you going today, Dhruv?
Good, Chris. How are you?
Yeah, very good. Now, there's a lot of concern in the markets right now about the potential for particularly US stock markets, but Australia has certainly been following suit there to have a big correction. Before we dig into that specifically, I thought maybe if we start by looking at the historical background for this, because you really make a compelling argument time and time again about how this is very consistent with what we've seen in history. And we do go through these periods where stock markets underperform while gold and silver outperform. But start us off with the stock market history there that we can learn from when we pull it back a little bit later into what's happening today.
Absolutely. So you can look back at stock market data going, 100 years, and you'd see these very consistent patterns repeating, where every 20 years or so, the stock markets, major stock markets, you could just take the S&P, for example, they spend about 10 years chopping sideways in a range where they're really losing value over and over again. And usually in these phases, commodities, but very specifically precious metals, are outperforming significantly, experiencing massive capital growth, while stock market participants are just spending an entire decade chopping sideways. So we can pull up a chart of this as well, but I think it goes from about 1928 to 38, which was the Great Depression. There's a phase from about 65 to 75 as well, which was the Volcker era, fighting inflation, controlled demolition of the economy. Then we had the dot-com boom, or the dot-com bust, I should say, to the global financial crisis. So that's about 99 to 2009. Again, you can see about 20 to 25-year gaps between these phases and about 10 years where the phase lasts. And the chart's quite compelling, where you just see the stock market ranging sideways. And if you overlay the gold price on top of this, you'll see gold in these specific phases massively outperforming.
You mentioned a term there that I'm just going to pick up on, the controlled demolition of the economy during that particular phase of time. There's a lot of speculation that what we're going through at the moment requires some sort of controlled demolition, in quotes, of the economy for us to be able to have an addressing of the debt, the underlying issues that are at play there. What do you think about that? What do you think at the moment we're looking at? Because there's certainly some technical indicators right now that are suggesting that things are not looking great. So how do you view where we are at the moment in the stock markets generally? Because Australia and US are both following a very similar script there. And is there something afoot that's causing that underperformance potentially?
Yeah, look, I keep bringing things back to cycles. So what causes the collapse this time is anyone's guess, because the last one was the mortgage-backed security housing crisis in the US, and the one before that was the controlled demolition. Now, the argument that we need a controlled demolition makes perfect sense. The system is way overstretched, and a recession or a forced recession would essentially solve most of the problems that we have today. Unfortunately, that's not a very popular stance to take. And doing it the way they did it in the 80s is not possible just because of the government debt. You can't have interest rates held high for a consistent amount of time while the government's got, $37 trillion worth of debt roughly. They'd go completely broke. So how they do a controlled demolition, if that's the way they do it this time, will look very different. But, if we look at cycles, and if we look at, looking at that phase on the stock market where they spend 10 years going sideways, there's a few different indicators. There's the technical indicators. So on the 12-month chart, it's essentially the phase where the stochastic RSI is resetting from overbought to oversold. And you'll see that on that chart that we pulled up before as well. And then there are the economic indicators leading into this. Now, if you look at it at the moment, the commercial mortgage-backed securities, the delinquency rate on these are an all-time high. They're higher than they were at the global financial crisis peak. And, they started tracking this in 2025 years ago, and it just hit 11%. So whether that commercial real estate has something to do with it, whether inflation has something to do with it, whether it's a controlled demolition, I don't know what's going to cause it. The hiring rate's been declining for the last 5 years. Credit card defaults are at the highest they've been since the global financial crisis. So it could be something breaking the economy, could be something a bit more controlled. But finally, looking at the cycle indicators, if you look at the 18.6-year land cycle, you'd expect a peak between 24 to 28. Now we're in 25 now. So the latest peak, according to 350 years of data, if the longest cycle ever would bring us out to 28, which is a pretty compelling argument to say that there'll be some sort of peak and then crash of broad-based financial reset before 2028 or at the latest by 2028. So we're not far from that peak. And then looking at the 80-year cycle, we're expecting a broad-based systemic reset towards the end of this decade as well. So what causes it? I don't know. And there are so many things that could cause it. I mean, really take your pick. But it's the cycles that indicate that from a timing perspective, we're getting closer every day. We are probably at a phase where liquidity will increase, complacency will increase, and all markets will rise. But then following that, we're not far from the actual collapse phase and then the recovery phase that follows. And bringing it back to gold and silver, I mean, the gold market clearly knows something is afoot, just the way the prices have been moving, the physical settlements of the futures markets, the lending rates in gold. There's enough alarm bells ringing in the gold market itself. We don't need to look too far to know that we're not far from some sort of collapse. And the liquidity phase, where greed increases and complacency increases and all markets rise, they do benefit gold and silver, being hard assets. They will benefit from an increase in liquidity. But then once we have the crash and the correction in the recovery phase, that's where you see stocks going sideways for 10 years. That's where you see most markets struggling, even land markets, but gold and silver outperforming at that time because they're a safe haven, they're decentralized, and they've got intrinsic value. So that's where, if you really want to navigate this pretty complicated time, rather than trying to time it perfectly, being in risk assets and then switching over, you could really take advantage of this phase and the next phase right to the end of this decade by getting into safe haven assets early on and benefiting from a liquidity increase and then benefiting from a safe haven requirement as well.
See, I always like talking to you about this because you take it just from a different angle, and I really struggle at the moment because there's so much news, there's so much compelling so many compelling arguments that can be made both ways for what's going to happen next. And you sort of say to me constantly, just ignore all of that because it's just part of what happens in the cycle. And you make that point that really you don't know, or you don't even need to know what the particular tipping point will be, the particular piece of news would be. And I think that's the part that I find the hardest to grapple with, because there's been such significant news over the last month, really, since the start of the Trump presidency in a whole range of areas. Any one piece of that news could be enough to send the markets tumbling or rocketing, and we really haven't seen either. We're starting to see potentially a little bit of a rollover, but it's so counterintuitive because most people would go, well, hang on a second. When you announce tariffs on your closest neighbours, that's going to be the thing that tips the markets. And traditionally, when we've seen a market top, it would be something like that we've attributed to it. But that's not really what was going on based on your analysis of it. It was just the underlying cycle. And that's so refreshing and interesting. I mean, I can't fully divorce myself from what's going on in the world, but to have that background, I find really helpful in this discussion and in this analysis. So
yeah, just really, to comment on that as well. So there's two sides of it. There's the news stories and then there's the technical indicators. And yeah, we've got plenty of technical indicators flashing red early on, giving us clues that, we're not far from something like this. And then there's news stories. Now with the technical indicators, you can have indicators flashing red while the trend continues up in the face of that for longer than most people imagine. The market can stay irrational longer than you can stay solvent is a pretty well-known expression. And just because one indicator is flashing red, that doesn't mean we're going to collapse today. That's what brings me back to these timing-based cycles where you have a window where you know that the increasing number of indicators will keep flashing red as we reach the peak. But we don't need to worry about which indicator it is or how many indicators we need to see. We just know that from a timing perspective, we're getting closer. And then the other aspect is the news side of things. Now, I'll argue that if we're having a lot of negative or fear-based news happening, we're very far away from a cycle peak because the news will be a counter indicator from my view. So when everyone's saying that, oh, Trump's amazing and, his tariffs worked out perfectly and nothing can ever go wrong, that's when I'm starting to get nervous from a news point of view. When everyone's really concerned with the news coming out about what Trump's doing, I wouldn't be too concerned about being at a peak just yet.
And that is the hardest part of all of this, right? Because it's so contrarian, and even everyone thinks they're a contrarian, goes, oh, well, I'm doing the opposite of what the market does. But it's really hard to do that because some of the news is very compelling. I think probably the last question to wrap this up is around this concept of exactly what you're describing in the winner's curse. And you refer to that very specifically when you say we could actually see a rise in all these markets against this backdrop of bad news, which is what you were just highlighting. But then the peak ends up coming right at the time when everyone started to be convinced, actually, it wasn't bad news. It was actually good. It's all worked out. And that's the peak. That's so challenging to navigate. So can you maybe wrap this up by talking to us a little bit about that, and then potentially how you address that yourself? So how you deal with that. Obviously, you're looking for those indicators and things to line up to tell you, but how do you psychologically deal with that? Because, I mean, maybe the answer is we just buy gold and silver into that because it's too hard. Like, that could be one answer. But for people who want a little bit more depth in that response, how do you personally think about it?
Yeah, great question leading into the winner's curse phase. So when you're at the peak of the winner's curse phase, you're going to see broad-based complacency and greed. Now, there is a phase where just before the peak, when everyone is right and the news is positive. So being a contrarian in that phase might not actually pay off.
That just makes it even more complicated.
So you really want to go with the trend for a little bit in that, not the trend, sorry. You want to go with the mass consensus in that phase. So what you'll see leading into the winner's curse phase is the wall of worry phase, where it pays to be contrarian, where everyone's really concerned about things not working out, but markets continue rising in the face of negative news. Then you reach a phase where the news is positive and everyone's winning and everything's going up together and people can't do any wrong. Now, this is required for the next phase. You need this broad-based complacency to increase to allow the crash phase to occur, because markets need to get overextended and retail investors need to keep buying the dips on the way down as exit liquidity for the big players. Unfortunately, that's how the game is. It is fairly rigged in that sense. So in terms of how to deal with it, when you're seeing negative indicators and prices rising and a lot of negative stories, it validates where you are in the cycle. When you're seeing positive news stories and everyone being really positive and liquidity increasing in the face of negative indicators, that validates where you are in the cycle. And then when you're seeing everybody being complacent and everyone saying, nothing wrong can happen now, we've got blue skies ahead, and positive news stories for an extended period in the face of negative indicators, and you're looking at a timing-based perspective on the cycle, that validates where you are in the cycle. So all I'd say is keep a macro view of where the cycle is and where you are in the cycle, and use technical indicators and news stories and sentiment to validate your position in that cycle. So rather than basing it off the events, base it off, okay, I know that the cycle's got a peak between 2024 and 2028. I'm going to use all these indicators to work out where exactly I am in this cycle. And then the final stage is to not get greedy and not get caught up in that mass greed and that mass complacency, and to be one step ahead of everyone. So if the next stage, or arguably the stage right now, is to just get into precious metals, there's no point trying to wait for everyone to be getting into precious metals for you to get into precious metals. If you position yourself one step before everyone else early on, then you'd see that benefit by getting in at a lower price. You'll see liquidity rising, and then when everyone joins you, that's actually the blow-off phase of that market. So keeping a broad view, using indicators and news to validate where you are in that view, and then being one step ahead of other people by not getting caught up in greed are probably the three basic rules, I think, that will help you navigate this phase. But for people that don't want to navigate it too closely, really just getting into precious metals early on, you'll benefit from both phases anyway. So there's no point trying to outsmart the market and get too cute about it. I think you benefit from increasing liquidity, you benefit from a safe haven requirement, and then you can chill for the next like 10 years and just position yourself in a way that you're not looking at charts for, 3-4 hours a day and live your life. So,
Well, I think if we take all that on board, but also just keep you along with us for this journey over the rest of that cycle to give us your insights, that's certainly going to help, because there is a lot to it. It's very simple when you lay it out, but it's actually complicated in the moment because, as you pointed out, there are periods where good news is good news. There are periods where good news is bad news. There's periods where bad news is good news. It's very complex to know which. It's simple once you know which stage you're in, but complex to know and maintain that conviction that you are in that phase. So always appreciate your work on that. And I'm sure everyone will appreciate you continuing to keep us up to date on where we are in that cycle as we progress through it. So thanks for that today, Drew.
thanks, Chris. Always good to chat to you.
Always good to chat to you. Thanks everyone for watching. We'll chat again soon.